All right, folks. So we are looking at the weekly chart of the dollar index, and the question has been, where are these levels coming from that were salient to the dollar index? If you go back to 2002 for the dollar index on TradingView, the symbol is DXY, and you want to be looking for the one that has TVC. Okay. You'll see that there is a small little gap right here. This candle's low, this candle's high. That's what I'm framing it on. So that's where I was looking for price to draw up into. Okay, so that we know where we're at. On the daily chart, you can see the market did in fact trade up to what we were looking for. Not surprising, because it's a higher time frame order flow. We have been seeing price move from a fair value gap here, rallied, took out a high, retraced back down into the imbalance here, fills that in, consolidates, creates an SMT divergence between this market and the euro dollar, as I mentioned in, I think it was Wednesday. Yeah, I think Wednesday's video. You also seen the SMT divergence between the dollar. The dollar should have made a lower low here. That's just what I'm basically drawing your attention to. And you saw this on the Wednesday video. The SMT divergence is because the dollar failed to make a lower low than this low, while the euro dollar made a higher high comparably. Okay, so if you compare these two specific dates, dollar did not make a lower low. So that's how we can measure institutional accumulation of long positions. It's not indicator based, it's based on price only. And that's how you want to be looking for accumulation. You're not looking for it with an indicator like, well, I could give you a laundry list of things that people claimed it teaches or shows and illustrates accumulation and distribution, but there's no better way than price itself. So when we look for SMT divergence, we're looking for a market that's already predisposed to go in one direction or the other. So I'm not looking at the relationship between highs and lows in correlated or inverted correlations that in itself makes the SMT divergence. No. I'm looking for markets that are expected to go higher. Then I'm watching price trade in areas where I'm expecting things to occur anyway, the imbalance or an order block, which there is no order block in here. So the imbalance it trades down into, then it fails to make a lower low when euro dollar makes a higher high. That is a crack in correlation. That is my SMT divergence, smart money technique or smart money tool. Like I said, I've never really settled on what the T stands for. It's been interchangeably used for tool or technique. But I guess it really could be smart money timing. You know, I guess you can add a third thing there to really confuse you. Oh, ICT, you so diabolical. But you settle on whatever you want it to mean. But whenever I say SMT, I'm looking at the relationships between important highs and lows in correlated markets. So if we're expecting the dollar to go higher, as we all know I was expecting it to see it go higher, then that is a expectation on foreign currencies like euro dollar, Australian dollar, cable, pound dollar to go lower. So we would be comparing the relationships between those foreign currencies, highs, versus the lows formed in dollar. And if we see things like this and it shows and illustrates that the dollar is under heavy accumulation of longs, this is extremely bullish. And because it's a higher time frame analysis, we need to know where price is going to reach to. Now, I'm quite confident that none of you probably were expecting price to draw up into these specific levels had I not drawn your attention to them. You would have been looking for something else, I'm sure, but not specifically these levels. And bottom line is, it's not important for you to know everything. It's not important for you to expect that you're going to know everything. Sometimes the market goes way beyond where I'm expecting. In fact, you can see it does go a little bit above where I was looking for it to go to. I don't care about that. As I mentioned on the Wednesday video, once it trades to 107.61, we are done for the week. That means the market's going to cap. It's going to create its weekly range expansion extreme. Or basically what we're saying is it's going to be the high on dollar and the low on foreign currencies. Here's the hourly chart on the dollar index. You can see how we had a nice little run up into that level. A little bit of a blow off move, not much, but did go above it 2 times. Then broke down, had a little bit of a fair value gap here, overshot that. It's not that it's a short because we don't want to be trading short against this. The market breaks down. I like the idea of sticking to higher time frame bias and avoiding trying to pick tops or picking bottoms. I know that feels sexy because some books and maybe some authors out there have done things in the past where they've illustrated how an indicator or a particular method has called the very high or the very low of a particular market. I'm not going to stand here in front of you and say that that's possible, that I could do it, because every time I've tried to do that, historically, I've paid the price and basically lost money. So if you haven't by now noticed that I'm teaching you how to work within a framework that doesn't require you to be picking tops and bottoms. You're looking for that meat in the middle. There's a lot of meat on the bone, and you don't need to be grabbing the last piece of meat or the first bite. All that meat in the middle of the bone, there's plenty for everyone to eat there. So if it's important for you to be so precise, focus on being precise in the middle of the big moves. That's where you should feel satisfied, when you're getting really close, tight precision, small stops. Not that you need really small stops, and I'm not trying to promote that, but as you graduate towards, excellence in your pursuit of consistency and profitable, those things are not important in the beginning. Those things being precision, because you have to determine where the market's going to draw to. And obviously, by having these levels, shown to you, it's pretty obvious now where it reached to. And I've had a lot of feedback, in the comment sections of the videos on YouTube and the feedback on Twitter, that it's resonating with you. You got a taste of what it feels like to know what the draw and liquidity can do for you, how it works with the market overall for intermarket relationships, and all these supporting ideas, not just in one asset class. Which brings me to the discussion I want to talk a little bit about tonight is, since the dollar has gone higher, let's go back up. Since the dollar's been going higher, that is a risk off scenario. If the dollar's going higher, risk off means that foreign currencies and assets other than the dollar are more likely to go lower or have a difficulty rallying higher. If there ever is an asset class that is rallying against this higher dollar, is that setting up a sell scenario for that asset class? No. What it's doing is it's signaling in the purest, most strongest manner possible that it is not going down. It is not bearish, because it's fading. It's resisting. It's being relentless about it not going down with a higher dollar. So, what can we use that with in terms of bias? I'll bring that up again when we get to the S&P and index futures part, which will be the end of the video. But just remind yourself that this is the risk off scenario because the dollar's been going higher. That is going to be a further amplification of using bias, and why I was able to operate the way I did, and you all watched that this week, why I was looking for specific things in the index markets. And the 15-minute time frame on the dollar index, you can see we had a nice little Judas swing here at the London Open. Trades down and then rallies up, runs into the liquidity at 107.61. And then we had a nice little breakdown here, short-term little low here, small little, tiny little gap here. Oh, ICT can't be there. No, it is. There it is, and it starts to drop down, and your liquidity is right there. It runs into that. All right, and you can see you have a small little fair value gap here. We have a low, rallies up, breaks that low. We don't need to close. Rallies back up into a fair value gap and breaks lower, attacking the relative equal lows here. So that's going to be fuel for a intraday rally on foreign currencies, and then going into the close. So we have relative equal lows here. There's your sell side, and buy side would be here. Eurodollar daily chart. Here is that high, higher high, higher high that was shown to be the opposite of what was being shown in the daily chart for the dollar index. Because at the time in here, the dollar was not making a low, a lower low, and a lower low. It wasn't doing that. It was diverging with the relationships of Eurodollar. So what this was doing is it kept stopping shorts out until it completely closed in the imbalance here. Then it broke lower. We have an up close candle here on, what is this, Friday, Thursday, Wednesday, Tuesday. We opened, rallied up into the bearish order block, and then aggressively ran for the sell side liquidity here, and then dug in deep. And we had a nice little reversal intraday on Friday with profit taking and the weekly range being capped, as I mentioned, when we got to 107 level on the dollar index. Hourly chart for Eurodollar. Okay, you see we've been trading off of the imbalance here, all this in here, retracement, and then overnight we had a run back up into the fair value gap here on the hourly chart, which will be used when we drop down the lower time frame. Then we finally get the capitulation into Friday's trading, making the low of the week. All right, and here is that midnight time window I'm teaching you to look at. Opening price here, extend that out in time. Notice what we've had prior to midnight. We rallied up, then we broke down, so we have a shift in market structure here. So from here to here, there's your dealing range. 50% or equilibrium's here. We have the gap on the hourly chart. That's what's being shaded here. Okay, before I drop down into this 15-minute time frame, the shaded area on the hourly, that's what this little box is. Now also, from the high to the low, that dealing range, after the shift in market structure here, we have displacement, measure the range, equilibrium, so we want to see it trade above that, ideally for what? A premium. Notice what's occurring here. It does go above equilibrium. It does so during London Open. Look at the time of day. And look real close. What is that? Small little fair value gap inside of the hourly fair value gap. So we're looking at things fractal. We're breaking it down into more detail, more refinement. So you can see we trade up into that smaller 15-minute time frame fair value gap, but it's inside the larger hourly fair value gap. And we have the relative equal lows here. So what's resting below that? Sell side. And they run aggressive with speed, taking us into the sell side liquidity here. Now, if you look at the Fibonacci, lay it on this high to that low, you'll get targets. And if you take it from here to here, you'll get a projection for this level. Then here, I'll leave that for you for homework. But we reached down below the big figure, 1.01 big figure, hammered that, and that was the time when the dollar index was posting its bearishness, started to go lower, and then we had this nice rally up on Eurodollar. All right, here, E-mini S&P daily chart. And this is the levels that I tweeted this morning, right before, 1 minute before. Why'd you wait till the last minute, ICT? Because there's a lot of people out there like to take what I take and share, and they'll use it for themselves and try to get credit like they did it themselves. So I'd like to wait till the last very minute for that very purpose. So that way it was so little time that no one can really do anything with it except for retweet it. And there it is. Some of you might not think that that's a big deal, but to me, it's a big deal. So this candle's high right here on your daily chart of S&P, and the symbol for this is ESU 2022 on TradingView. That candle here for Wednesday's high, and then Thursday's high. So between these two levels here, that was the dealing range I was working with. And I teach this, and I taught this when I was on Baby Pips. When I first came out and started teaching publicly on that forum, not because that's when I started teaching, but I started teaching in the 90s as well. But daily highs and lows are one of the first things I brought everyone's attention to. And it's because there's real order flow around these price levels. previous day's highs, previous day's lows, and highs and lows in the last 3 days. That was one of the first lessons I taught on baby pips with Forex. Well, this is not Forex, right? Because what I'm teaching works in everything. So we have the high here and the low here. That's these levels here. So when we go into the lower time frame charts, you'll see white levels. That's this here, okay? This part of the video is going to be very, very easy for you to get lost in the discussion. And sometimes, because you're watching the video with 2 times the speed, and I sound way faster than I ever talk in my real life, okay? Very methodical about what I'm about to say. I'd like to think about what it is I'm going to say, because I'm anticipating what I'm saying and what questions are going to arise in your mind. So because you're watching the video at a fast rate of speed, 2 times the normal playback, invariably you're going to miss certain things. And proof of that is, if you look at some of the comments in the videos that I've been posting in this mentorship and in these reviews now, questions that are obviously answered in the very video that students that or viewers, casual viewers, they're asking the very things I'm talking about in the commentary for that particular video. So this is one that you're going to really want to stop the speed up, version of listening to me. Just go through it the right way, okay? Because if you don't pay attention on the higher time frame charts on where I'm putting these levels at, when we drop down the lower time frame, it's going to look really busy to you. Now, my chart is not like this. I'm trading naked. The only time you see me putting anything on the chart, which is what I refer to as lipstick, that is for your benefit. I don't see this on my chart when I'm trading. I know what I'm looking for. I usually have a pad with notes with specific levels I'm looking for, and I'm writing down specific times of the day I'm looking for those levels to be utilized. Morning session, PM session, not during lunch, that type of thing. So I'm really sensitive to certain price levels, and I'm watching price gyrate to, away, above, and below these types of levels. But I have a bias in mind. Now, I started this week, obviously, with the expectation that we're going to try to gravitate up into this imbalance from here to here. So all the movement here, this is not too much selling. This is not the sellers had control and selling pressure caused this. Okay, this is repriced. This is all repricing. The algorithm keeps offering lower prices no matter how many buyers coming in. It does not matter. The market keeps offering it lower. What does that do? It causes people to be more reluctant to hold on to their longs. So what are they going to do? They're going to start selling their longs. Okay, and that selling allows smart money to accumulate all of that because they buy early and they sell early. Now, it's not my point to go over market making in here, because that in itself is another topic that could be mined for hundreds of videos and not really scratch the surface. But just know that we were looking for this movement in here to rebalance this. Now, why? Why would I expect that? Well, we had the inability to get down. Here's Friday, Thursday, Wednesday, Tuesday, Monday's trading. Okay, Monday, we were unable to get below previous week's trading day here on Friday, week before. Couldn't get below it. And look at the reaction there. We took out Friday's high of the previous week. So, shouldn't this market be trying to go lower? Well, with the dollar going higher really hard, that's risk off. Is S&P showing it's wanting to bend its knee to it? No. We have this imbalance. So this is signaling that it's not wanting to go low. The next day, what happens? We open, we trade down. What's it doing? Coming off the lows. It's under what? Heavy accumulation of longs. So what is this market signaling? Is it going in line with risk off, risk on scenario? No. It's doing something different. It's showing a willingness to want to go higher when other asset classes should be having difficulty going higher, more likely to go lower. So is it showing bearishness? Absolutely not. So we're looking for higher prices. So this is how bias can be a little bit more complicated, but obviously you have to consider other factors, intermarket relationships. That's why it's so frustrating for most of you to sit down with me and you want me to give you a 1, 2, 3 ABC formula that makes bias flawless, bulletproof. You can't lose. It's always going to be the right one. It requires more things to support it. What was that? The fact that we had the SMT divergence on the dollar. The fact that the euro dollar went higher. Oh, I'm not a Forex trader, Michael. Come on. You're talking about Forex. I'm only interested in index futures now. You've now convinced me that Forex is lame. I want to be in index futures. Don't talk about Forex. I'm focused on this. I'm focused on the markets. I am focused on the markets entirely. Just because you see me executing in Forex pairs, or if you've been recently watching me execute in index futures with live account, those things are leaning on the same logic that I use with Forex. And the same thing I was using when I was trading commodities back in the 1990s. So there's things that you're going to need. They're pillars of understanding. And they have to be understood over lessons and experiences that we understand what it is I'm doing. That's the reason why I tell everybody, to learn with me properly, you got to at least spend a year. Because you'll see a full calendar year. You'll see the seasonal influences in the beginning of the year, the summer, and in the end of the year. You'll see holidays. You'll see unexpected movements. You'll think, oh, wow, everything's going to be easy. And all of a sudden you get a curveball like this. And unless you're sitting with me and watching it unfold and I'm outlining and explaining to you why it should do what it's doing, you won't get it. You'll just look at this as, the market just did something screwy there. Or the market makers got me. I fell victim to the harmonic Harry pattern. Something silly. When it's just sound logic that you're lacking, that I'm obviously laying down for you right now. So, S&P was bullish this week because we've seen on Monday and Tuesday a reluctancy to go lower. So, yes, Forex pairs are going to go where? Lower. I'm not interested in trading Forex right now. My focus is in index futures. I made that very plain to everyone. So, if I'm going to be trading index futures, am I going to be selling short in a risk-off scenario? No. I'm going to be looking for the relative strength leader between NASDAQ and E-mini S&P because it's going to go higher. See what I've done there? I've taken intermarket relationships. I looked at other asset classes. I've used the risk-off, risk-on scenario to frame risk and also to build the bias, the framework. And I've narrowed my focus down to, okay, I want to be long, so I want to be in markets that are going to be reluctant to go lower and create an SMT divergence. I want to buy the market that makes the higher low, even though the one that makes the lower low might go up in sympathy. I want to be in the market that does what? Shows its unwillingness even on the lower time frames to go lower. Because what I'm doing is I'm getting the cream of the crop. I'm getting the best of the best of the best. Understand? So, let's drop down lower with more levels here. This is the gap we've talked about. I think I've talked about it. I got two communities here, so I'm getting a little confused, but I'm quite certain I mentioned this in passing, at least in the mentorship videos and all the discussions since I began in January. But this June gap, I have this level here. This is going to be like a purple, okay? It's a dashed line here, and it's the high of this candle here. So it's the low of this candle and the high of this candle. That dashed line is in purple. That's these levels here. So this is where you're going to get confused if you're not paying attention. You have to turn the TV off. It's just me and you in this chart for the next half an hour or so. If you don't pay attention, you're going to get lost in all these lines, and it's not going to be helpful to you. What I'm showing you is real support and resistance. Okay? Everything you've ever learned about support and resistance, throw it away. Throw it away, because you're going to look for things that are not going to be consistent. The things I'm going to show you here are consistent. Okay. You see the folks on my Twitter feed, and I share a trade or I do an execution, and they're like, I don't understand how he just did that. Well, put your thinking cap on, get your notepad ready, write down the minute markers of the video, because you're going to want to go back into those moments where I said something and you want to revisit it again. Okay. This is that kind of video. If you're just lazily just going through casual listening and watching this video, you're not going to get as much as you would have if you really chew on it. Really dig into this one, because this is some of the best stuff you're ever going to get from me. And this is how I trade. This is what I'm looking for. This is the logic that's in the trades that it's not in your charts. You're not seeing this in my other students that, don't want to say that they're my students. They're trying to pretend that they've invented this stuff on their own. They have not. This here is the logic. We have a gap. That's a real gap. Now, supply and demand, which I don't trade with, I think the logic is infantile in the beginning. It's, in my opinion, better than support and resistance, but still infinitely less than what I'm teaching. That's not a knock against them. It's not against anyone that uses supply and demand. I'm just stating the facts. What I'm teaching you here is the real precision, because this is what the algorithm's doing. I don't expect you to believe me because I say this. You're going to see it. You're going to see it right in this chart. You're going to see why I did what I did trading this week. They were real executions. They were not hindsight referred to in a market replay. They were a button pushed, managed with a stop loss, targets being hit, partials taken along at logical levels. There's real sound logic here. And if you cheat yourself and not pay attention to it, well, you know the score. These types of gaps, they will be revisited in future market delivery. What does that mean? Well, because I don't trade with supply and demand, and I think this is one of the facets about supply and demand that is absolutely incorrect. Supply and demand and its proponents, they like to say that they want a fresh zone. First of all, I don't deal with zones. I'm looking at specific price levels. I'm looking at a specific price level, not a range where who knows what price level is going to be the one in there. I know exactly the level I'm looking for. My students know exactly what level they're looking for. It's not some ambiguous range that who knows where they're going to key off and what to buy, what to short on. How's that useful? You're playing a guessing game. I don't want to guess about what level I think is a key level. That's what I'm showing you here. That gap, you want to have the high and the low of that gap and extend that in the future. How long? Until it moves away from it. What? Yeah. See, supply and demand and its creator will tell you you can't cut through candles. That is a farce. And I'm going to show you why that's a joke. Okay. You have to know this. You have to know this because the markets are run by an algorithm. They are not looking at ranges that are ambiguous, supply or demand. That's not what's going on because the markets are not being controlled by buying and selling pressure. They're being controlled by algorithms. And it doesn't matter how much buying and selling are going on. The price of the asset is being repriced and booked on its own delivery. Not because so many people bought or so many people sold short. And that's a very hard thing for people, especially people that have been trading for a long time. That's why I'm able to see things that don't look like they should make any sense. And why is this trade working like this? Why is it so precise? Why am I getting in? And why is it turning? And why is it going to where I think it's going to go? Because I'm in alignment with the algorithm. I know what the algorithm's trying to rebook to. When these runs turn at these special little areas that I'm looking at on my chart, I'm not all the time making that attention to detail in the trade because I'm trading. I don't have time to do every little detail. But the logic I'm seeing in price, this is what I'm showing you here today. This is what I was looking at the entire week. Why I was mapping out all my expectations, why I was looking for certain things, why I was going to gravitate to. When it gets above a certain level, how would I expect to use that information? I want you to get that from tonight. Okay? It doesn't mean you're going to learn it all and understand it and go out and do it next week. But this is how you build a foundation. I'm putting down tent poles. Okay? I'm building a foundation. I'm pitching a tent. Okay? You're going to have to spend some time with this stuff. And that's the wonderful thing about doing reviews. You'll see these types of things repeat. And by repetition and taking it in each time, getting a little bit more understanding. And over time, what will happen is you'll have a better understanding of the tapestry that price creates day by day, week by week, minute by minute. So we don't believe in not cutting through candles. You're going to get the real narrative by cutting through candles. One of the best things you can do is look for these real gaps like this. Okay. Also, in TradingView, there's a setting where you can do the electronic trading in I forgot what they call it, but there's 2 settings you can do for charting. And you want to have both of them toggled back and forth. And wherever you see gaps like this, there's lots of them when you're using non-electronic trading hours. Those gaps you want to have on your chart. And guess what? My private group just learned something because I've never taught that anywhere. Okay. I've taught it in early lessons when I was talking about S&P trading on baby pits, but I've taken that video down. And to be honest with you, it's not good enough to be put back up on YouTube. I'm actually doing a better job of teaching it here. But real gaps like this, you want to extend those in time. Okay. Same thing with a weekly opening gap. Whenever you see a weekly opening gap, the gap's lower than the previous week's Friday close, or if it gaps, gap up or gap down away from the Friday's close. That gap, you want to have that and you want to mark it and extend it through the entire week because it will be used as support and resistance. Once you do this a few times, you're going to laugh at the whole idea of supply and demand's logic, if you want to call it that, of not cutting through candles. Gaps are a real thing. And just because the market goes up here and overlaps that gap here, and you would assume that that's rebalanced, right? It's not. That's not rebalanced because it went up here. Okay? This is not a knock against Chris Laurie, but he teaches that once this thing here would go up, that's rebalanced. That's not rebalanced. Okay? That's this redelivery. It's being offered for the first time here. It's not rebalanced until this candle. What? Watch what happens. There's no data here. No trading took place from this candle's low and this candle's high. There's absolutely zero. So if you're looking for a liquidity, quote unquote, void, that is what that is. There's a void of liquidity because there's no trading. This is not a liquidity void. This is not a liquidity void. This is not a liquidity void. Okay. This is a real gap, no trading. So you have to define that gap and extend it through the week, or even as long as we're close to that gap's high and low, it's going to be in my mind on my analysis. Now, if we get above this high here and starts going higher, I'm not interested in that gap because it's too far away. It's not salient anymore. But because we're close to it on Wednesday and Thursday and Friday's trading, I need to reference these levels because they're going to be pertinent to what the algorithm is going to refer back to. The algorithm is not looking at these imbalances here solely. It's looking at this because this is the most paramount, because this was a void. There was no trading going on there. Zero. So how does the market efficiently offer price between these two price points here? It has to trade there. Well, it does that here, right? So job's finished, right? Pack it in, it's over. No. It offers buy side, passing through the low and the high range. Once it does that, the only thing it's done there is offered buy side. To balance it and rebalance that range between that low and that high, it must trade back down through. So it's a pass of 2 times. It goes up through it and then down through it. That range here is balanced when this candle passes down through it. So you're getting both sides of the coin, buy side and sell side. That is a market truism that nobody teaches that. I'm the only one that teaches that because I'm the only one that's going to divulge this stuff to you, and the way it is. You're going to hear echoes from people that listen to me, learn from me, and they're going to go out there and rename everything. But I promise you, none of this stuff existed anywhere else before me. You're not supposed to learn this stuff. It's not for you to know. But this is what the algorithm does. How do we use that information? Well, the market breaks back down and goes below this gap. Okay, once we go below that, it's trading back down into this area here. So all of this here is now getting rebalanced because this range up needs to have what? To be balanced, it has to trade back down. So a green candle up needs to be met with well, in my case, the down candles are black. So when it trades back down into this range here, this becomes balanced. Now look closely. We have Friday, Thursday, Wednesday, Tuesday, Monday. Monday's trading doesn't want to go lower during a risk-off scenario. Tuesday goes low, but then comes back off and says, nope, I'm not going any lower. So where does that take our attention? This imbalance from here to here. All this sell side now becomes the present dealing range, and it wants to gravitate up there. If we can get above this gap low, okay, the high of this candle, which is the low of the gap that's here and here, if we get above that, then we're likely to do what? Make a run for this. It doesn't have to happen this week, but I want to see, does this gap's low offer support? And also, remember the levels I started with when we were discussing the S&P in the beginning, the white levels? I don't have them here because it would be too many lines, but in the lower time frame charts, you'll see the white lines. It's this high, Wednesday's high, and Thursday's high. So on Friday, we open. What are we expecting on Friday? Non-farm payroll. Now, I don't advocate trading with live funds if you're a developing student because you have no idea what you're doing. The volatility that can come into the marketplace if you're trading with live money and you're rushing in there thinking you're going to get a big move and you're going to get lucky, you're not going to get lucky. You're going to get your clock cleaned. Okay. And that's the reason why I tell people don't trade non-farm payroll, because honestly, if you're listening to me, you're probably a developing trader. I have a lot of people that are well versed. Those individuals know how to navigate. They can participate in non-farm payroll. They're not listening to me because they've been doing it long enough to know when to work with it. But it's not beneficial, and I'd be doing a terrible disservice to any students that come by my way to say, go out there and trade non-farm payroll because there's volatility. That's stupid. That's a poor mentor. That's stupid. Okay. That would be so ignorant and irresponsible as a mentor for me to encourage anyone learning how to trade on those days. Those being Thursday before non-farm payroll and the very day of non-farm payroll, because it can be very chaotic and you don't have the understanding that, well, someone with more experience and have traded with live funds and traded non-farm payroll for decades would be able to navigate with. So don't listen to talking heads on the internet about me, okay, that want to try to derail you and say, oh, yeah, ICT, he can't trade because he doesn't want to trade on non-farm payroll because he doesn't know how to trade. No, I know how to trade. I've obviously proven it again today. But I don't want to be guilty of giving the message or conveying the idea that you should because I can. Remember, when I teach these things on YouTube, and I taught you that model just recently in this mentorship, that's not all I know. But you don't need to know everything I know. Just model alone that you've been given is wonderful. And it's simple. And you don't need to make it more complicated than that. But I love teaching. And also want to do market reviews because I want to put the people out of business that are selling my videos. So you don't need to buy those things. You're getting it right here, right from the horse's mouth. So we're going to drop down to lower time frames, and there's other levels I want you to see. This dotted line here is black. Okay, it probably won't be so clear on the lower time frames in terms of what color it is. Just know that down close candle, that opening price, that's a dot line, and it's black. And you have a heavier, thick green line here. That's this imbalance low. Okay, so it's this candle's high to this candle's low. That's this imbalance here. Okay, so we have the dotted line, which is the order block. The dark green line is the low of this imbalance, which will be useful on Thursday's trading. And then we have this red line here, which is the top of the imbalance. And the two purple lines are the old gap. Okay. Anything white is going to be this candle's high and this candle's high here. So you can see why I was telling you, pay attention. Okay. It might even be beneficial for you to have a screenshot of this chart where you can look at it if you have multiple monitors or something to that effect, or take a picture of it with your cell phone. So that way you can see what these levels are when we're in the lower time frames. It'll help you navigate them. So you can pause the video when we're in the lower time frames and see where you're at in the orientation of all these levels, because these are key levels. And I'll explain why as we go. All right, so here's the hourly chart. And this is the sell side imbalance I mentioned on Wednesday. And some of you were like, what is that? It's when the market only offers on the downside. It's not selling pressure. It's the repricing lower, and it's inefficiently done. So the market's going to do what? If it's bullish, it has a tendency to want to come back up into that and rebalance. Is it rebalanced when it does this? If you heard Chris Laurie teach, he'll tell you that's balanced now. It's not balanced. This is just redelivered. This is rebalanced. See what's happened here? This high of this candle, and we can't see here because I don't have it on my chart, but over here it's anchored to another low, but you can use this one as well. When the market trades up into that, when it trades up there, it's redelivered. So we have sell side. It runs up, redelivers for buy side, but it is not balanced until it goes back down again to that same level. Now it's balanced because it's done what? Sell side creates the imbalance. So what's it doing? It offers the buy side there, then it offers the sell side in a much more uniform, efficient manner. This becomes a support level now. What level? That level right there. That's how you find real support and resistance. Okay. I don't care who wrote a book. I don't care how many things that they get accolades for having the best education, talking about things in hindsight. Okay. I have a lot of useless books that talk about support and resistance, and they're nonsense. They're all a fallacy. They're comic strips. Okay. If I didn't spend the money and have so much time invested in energy and belief placed on them, I keep all of my books because they have sentimental value. I conquered all that crap. I can see through all this garbage. Okay. All these Renko bars and all the Heikinashi and the Ichimoku and you name it. Okay. It's all garbage. That's real garbage. Okay. Everybody wants to say what I'm doing. No, you just don't know what you're doing. You don't know enough yet. But nothing comes close to this, folks, because what I'm showing you is exactly what the algorithm's doing. The algorithm is not organic. Okay. It's only doing what it's programmed to do. It's referring back to these levels over here. Because now think about this. If this imbalance exists, we've known about it, the market's bullish, it's going to follow what? The logic that everything that would be otherwise bullish, does the market keep supporting price higher? Okay, well, let's go back to, we have that dotted line. That's the order block, right? Does the market find support at the order block? You can see the candles are kind of building up support, won't go any lower. Then it rallies up. Then it comes down into what? That old imbalance low. This is why I said take a picture or have a chart of it in another monitor or look at your cell phone. We're in that low end of the daily imbalance. It's finding support there. Look right here. What do you see there? And we'll get to that. Does the market rally from there? Yes. Does it trade up into the imbalance and reprice to this high end over here? That offered this sell side a buy side? Yes. So for the down close candle here that passed through, now we're seeing a green candle go up there. That's the first thing we're looking for. But then it does what? It goes down in to that same level again during non-farm payroll release. What's it going to do then? Reprice higher. Where's it going to go? We have a remaining balance here and bearish order block. Last up close candle before the shift lower. There's where you see your price going. Now, some of you are like, oh, come on now. This is all made up. Folks, I have an army of people that watch me do this every single day, every single week for years. I understand it may seem high and lofty to you if this is your first time you've been introduced to this, but I promise you the things that you're going to see in these reviews are going to start laying a foundation. The first time you see it, it's going to feel like, oh, come on, I don't really get what he's saying, because you're just being introduced to it. And that's normal. Anything highly technical, the first time you get introduced to it, it's going to feel very difficult and complex. And it's going to be very easy for some of you that are very lazy to say, I'm time to check out. I'm out of here. Goodbye. The folks that really want to know what they're doing and how to read and decipher price action and not require any hand holding, no indicators, naked chart only, I see this with nothing on my chart because my eyes go right to that area there, and I know where the order block is because I have it on my pad. The price level. I'm working off of a notepad with levels written down. And right next to those levels, I have a specific time that I'm looking for that price level to be traded to. That part is not going to be taught to you. You don't need it. That's the thing I hold back. You don't need that because you can see it in your chart. And if you just submit to what? Time. That's why I tell you, submit to time. If you wait for the kill zones, wait for the price to trade at these levels, does it give you the setup? What's the bias? Bullish. Where's it going? Here to rebalance, and then over here. That last little portion. That's what you're getting here. The purple levels. Remember that old gap? Look at the bodies of the candles here. That's the low end of that gap. Look at the bodies here. That's the high end of that gap on the daily chart where there was no trading. That's the real liquidity void. That's what's being shown here. See how price is gravitating around that? Look at that low and that candle right there. That's support and resistance, folks. That's the real thing. That's the real McCoy. Don't tell anybody. Shh. All right, so here is a zoomed in portion of the hourly chart for S&P. Remember that gap I said we'd go back into in a little bit more detail? Here you go. The market rallies above, shift in market structure, fair value gap, drops down in. Oh, look at that. That's the low end of that imbalance on the daily chart. Remember I told you a deep green level? Look at the bodies. Boom. Run away from it. See that? Rallies up into the imbalance, the sell side imbalance. Reprices there. Stretches its wings up into the higher fair value gap, into that bearish order block. And the levels I have here in white, they are the levels that I was sharing on Twitter this morning at 8:29, 1 minute before 8:30 in the non-farm payroll release. This is where I said that the liquidity levels I'm monitoring and watching. The sell side is here and the buy side is here. If I'm bullish, what am I looking for? Sell side, then go buy side. But what if it's trading here and we haven't got down to the sell side yet? What can I do with that? Well, I showed you today. I shorted it. And I'll give you some more details as we go along, because I know some of you are like, in the video, he says the fair value gap is not a buy, and then he sold short in it. Because I know some of you are looking at that, just like the yahoos on Instagram and on Facebook and on YouTube that take my stuff and they try to pretend they know how to do it and teach people and sell it for money, but they cannot trade the information. That's why I'm telling you, have them prove if they can do it, if they can make money with real accounts. I'm telling you, folks, they will gladly shove that proof down your throat. And you don't see that, do you? How about the other mentors out there? They got a lot of things to say about me, but they're not proving they're doing it. They're not explaining it beforehand. They're doing a lot of losing trades and then getting lucky with over leveraging. I'm going in, picking my shots. One trade, smashing any over leveraged results. Precision. Over and over and over and over and over again. That's what you're trying to learn. And that's why I'm pouring myself into this. Because you're going to learn how to beat the shit out of all this other stuff out there that permeates the industry. Yeah. I'm here to make you a monster. All you have to do is show up. These things I'm showing you here, this is just a little bit more complex than you probably are expecting. But I promise you, you have to dig into this. Study it. Do it with your own charts. See the things I'm sharing, then go into your charts and put them in your own charts. Study them. You'll see a lot more things that I'm actually talking about. But what I'm saying is obviously the most salient thing. We're going to look at the setup that was for non-farm payroll today. Here is the 15-minute time frame, and we have midnight opening price. We don't have it drawn out because I have enough lines on anyway, but you would be watching and monitoring that here. And the market does what? It drops down after going into the imbalance here, after taking buy side liquidity here. We break down, come back up, rebalance here, and then we sell off ahead of 8:30. Going into the 8:30 window, non-farm payroll is here. I did not capture anything up here. It moved too quick. In fact, you can watch the video that I have a link to. I'll put it in the comment section. I'll try to put the link and pin it like I did the other day with the other one. But the video shows me waiting for it to create a fair value gap, and then I want to see it rebalance. What does that mean? What I've already just taught you here. Then I go short, and I'm targeting that level here. It's trading down into a fair value gap that I don't want to be short in. I want to target that up here, down into that. Then, in the video, you actually see I'm going to buy the fair value gap that forms, or subsequent fair value gap rather, that forms once we take out that low. I thought about it, and I was like, you know what? I'm not going to do that, because if I do all that, it's going to just make the case that you should be in here trading non-farm payroll. So I just showed one example, and that's enough. But you can clearly see in the comments, in the annotations of the video, this was a buy. And the fair value gap that later on forms that I shared on the chart could have very easily been a run up into the buy side liquidity I gave far in advance reference to before we even started moving down. Okay. I know some of this isn't going to scratch every itch for some of you, and it's probably going to create more, questions. Just hang out. You're going to see a lot of things that you never thought existed in trading and precision and consistency. But you have to be here. You have to show up. And you have to roll your sleeves up and put the work in. Purple line here. That's the low end of that gap on the daily chart where there was no trading, that liquidity void. There's your bodies of the candles here, even on the 15-minute time frame. And it trades up through the high end of the gap. Comes back down through it, and then bam, hits it there and rallies through. Goes back to where the liquidity was above that white line. And it almost completely fills in that gap on the hourly chart and then into the close. Let's go a little bit more in terms of detail. Here's a 5-minute chart. Here's a fair value gap. Trades up into that ahead of 8:30 non-farm payroll. Breaks down. We have sell side below here. And then we have the imbalance down here and the liquidity at Wednesday's high. This is Thursday's high. That's what these white lines are. Okay. Wednesday's high, Thursday's high. Oh, see, all you're doing is teaching a ceiling broken becomes a floor, and a floor broken becomes a ceiling. No, I'm not teaching that at all. I'm teaching you what the algorithm's doing. Watch. Trust me. Just trust me. I'm taking you somewhere. Did it stop at that white line, which was Wednesday's high, and turn around? No. Did it stop here and turn around right at that old high on Wednesday? No. It went to where I teach, into the imbalance, into the top of the imbalance on the hourly chart. Remember that 38.7150 level? Go back and look at it. It hits it here and then rallies. Small little gap here. There's your entry here. You can be a buyer there. Rally it up into buy side liquidity. That's a 5-minute chart. Okay. We're going to go a little bit better than that. We're going to zoom in and we're going to incorporate SMT. So if we're bullish, we're looking for higher prices. Why? Because the index markets are shunning the risk off condition. They keep wanting to go higher. Okay. Non-farm payroll comes in. It's manipulation here. Trades down to a level what? The imbalance low on the hourly chart. Rallies. Drops back down in. Look at the low here compared to that low. See how it's lower? Now I'm plotting the NASDAQ. And this line is being plotted with the NASDAQ low because I'm comparing lows. NASDAQ doesn't want to make a lower low there when the S&P does. But the S&P is trading at a level that makes sense to me. So if I was going to be a buyer, I could trade this one here or trade this one. But I like this one because it's at a level that's already important. This is the low of that imbalance on the hourly chart inside of a fair value gap. Also, when we get into the lower time frame 1 minute chart, you'll see there's another fair value gap here that goes right into with that little drop there, right to the pip. It's beautiful. Then it rallies off. So we have SMT divergence there. And here's the 1 minute chart. Market's dropping down after the initial drop here at 8:30 non-farm payroll. Then it trades back up to this level here, completely random level, which I don't have in the chart because you're not seeing it. But I'm showing you what I was seeing in my mind with the data that I have written down on a piece of paper while I'm trading. My charts are naked. This is way too much stuff on the chart, but I have to have it on the chart for you to understand the logic. What's the things that's going on in my head? I can't sit down with a naked chart and say this, what I'm doing, and tell you just raw numbers. You won't be able to learn it that way. So when I put these rectangles on here, invariably people think it's supply and demand because that's what you see typically as supply and demand zones. Notice I'm showing you areas where it's going to gravitate to, but in those areas I have very specific price levels. It's not ambiguous. It's not some, well, try to figure it out. Hopefully I get the right one. No, I know what I'm looking for. And my students that are under me know what they're looking for. We'll come back to this for the trade setup that I actually executed on, but I want you to follow along with the logic. Here we drop down. Look at the body. Look at that. Respecting that imbalance. Runs away, leaves a fair value gap. We'll come back to that. Rallies. Comes back up to the top end of what? This is the high of that gap. Remember the gap on the daily chart? Look how it consolidated around the low of the gap. Consolidates, accumulates more longs, and runs away. Creates what? Fair value gap. Drops down into it there. That's a buy. Show me some setups, ICT. There's one right there. You could be a buyer right there. What are you going to hold it for? Well, you can take a partial here at the top end of that hourly imbalance. Notice that I'm showing you that my partials are not just some willy-nilly knee-jerk reaction because the market moved. This is levels where I would be taking a partial. When it gets to this level here, I'd take a partial there too. See the difference between understanding what I'm teaching you, deeper dive behind the logic. My partials are not random. I'm looking for these types of things. But because it's not imperative that I lay everything down in a chart, because frankly, I don't have the time. I mean, I'm in these lower time frame charts and I'm executing on things that are highly precise and I don't have the benefit of time to lay it all out. I can do that after the fact. And you can see with crystal clarity as to why I would be doing the things I'm doing. But it's important for you to go into the charts and see what these things are doing. And you'll see what I'm teaching here repeats. Every day, every week, every month, every quarter, every single year. But you have to have some kind of framework. What's that framework? Are you trying to build the case that you want to be a buyer or seller? That's not bias. So you're trying to determine what you should be doing. Is the risk off scenario with the dollar, is that bias? No, that's framework. Bias is finding the market that's in alignment with that idea. And indices have not shown its hand that it wants to be a part of that risk-off scenario. So it's been bucking that trend that would be otherwise associated with lower prices in foreign currencies and equities and such. It's saying, nah, I'm going to sit this one out. I'm going higher. So it's really strong. It's the stronger of the strong because it won't go down. So I'm focusing on doing what? Being a buyer. Well, wait a minute, ICT, you just sold short right there. Right, because I sat down in front of the charts. I wanted to give it an ideal scenario of reading price and studying liquidity on non-farm payroll. I think which is what I did today with a demo account. I did a demo trade. I'm following the logic and the rules I gave everybody. You should not be trading with live money on non-farm payroll Thursday or Friday. Don't do it. But practice studying liquidity, because these are hard conditions. So if you were able to do it in these conditions, when you have just regular bread and butter conditions that are not FOMC or non-farm payroll related, it's a lot easier to navigate the marketplace because you have worked in harder market environments. So anyway, the market has a fair value gap here. It rolls up into the high end of the gap on the daily chart, the one that has no data. That's this level here. Remember I told you to be purple levels here, and this is the low end of it. It rolls to it here and drops back down in. Look at how much time it touches the low level of that gap. This is a stale level, folks. Sam would have been like, no, it's way past its expiration. But look at the sensitivity. The algorithm is reading all this right here. This is all price delivery around a level that is highly, highly crucial for algorithmic principles. Look at that. Look at the bodies hovering around and stopping right at that level. That's the low part of that gap on the daily chart where there's no data at all. It accumulates here. What's it doing? It's trading, buying, buy, filling this little gap here and drop down into what? This fair value gap. You don't think this is important? I have a student right now on Twitter that shared that he was short and this is what he was aiming for. And I don't usually like people that are showing me their trades. And you all know this. People that post things to me. Hey, what do you think? You think this is a good trade? I don't ignore it. I do ignore it actually. I don't put a heart on it. I don't like it because that's me co-signing your trade. And that's what you're really asking for. You want the oracle in me to speak up and give you the okay sign that that's a good trade. No, I'm not going to do that because you're not going to learn anything by that. But because I knew that this was going to be a turning point, the gentleman on Twitter knows that I liked his post. And I liked it way before it even traded there. That was my way of being able to come back here and say, this is an area that even my students seen that as a target, but this is what? If it's bullish and it creates this lower low, not seen in the NASDAQ. Look at all the ingredients that are coming together here. Fair value gap, a larger fair value gap. We're at the low end of the actual gap on the daily chart where there was no data. And we have S&T. It's accumulating what? Longs. This was a stop hunt. Relative equal lows, boom to imbalance. That's it. Look where it stopped. Right to the point. Rallies above. What's it doing here? Shift in market structure. What's this? Fair value gap. Accumulation of what? Longs. Why? We're at the low end of that gap. There is no data on the daily chart. And a fair value gap. And we have S&T divergence. And we're at a discount. High, low. First partial here. High of the imbalance on this level here. Then the high of the gap with no data on the daily chart. That's another partial right there. Here's another partial here. And then we're in the shaded area. There's a partial. And then as soon as we run above here, that's it. We ran the buy side out. And then had the smallest portion on to see if you can get that imbalance that's on the hourly chart, that last little fair value gap with the bear shoulder block. And you see a little bit of an overrun here, but not much. And then right back down in, sweeping back above that old level, which was Thursday's high. All right, so here's the execution using the liquidity and the fair value gap and understanding the logic as to what's going on and deciphering what price is actually trying to do. The market moved away too quickly for me to actually do anything in here. The market trades back up to that old level. Again, look at this level here and go back to that chart where I said take a picture of it and you'll see what these levels are. It's returning back to that level. So that to me is important. I want to see this price move away from it. It does. This imbalance here, I knew before we dropped down into that, I knew some of you were going to look at that and say, okay, it's rebalancing this fair value gap and that would be a buy. No. I'm going to wait for it to do what? Look what happens, okay? We have the imbalance created here. So the fair value gap exists. The market drops down it closes this range in from the low or high of this candle to the low of that candle. All this movement up is balanced out right there, right? No. No, 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 no. All that has done is just repriced to this level. It's rebalanced and now balanced when it goes back up to that level there. Because of that, and because I'm expecting price to get down here, remember that liquidity level at 38.75 and a quarter, or whatever it was I tweeted this morning, whatever this white line is. Again, you can go and look at the tweet. I don't, unfortunately, have it in this presentation. I wish I would have added it now, but it's on Twitter. It was 8:29 a.m. New York time. It trades over top of this here. It reprices to that low of here. So all this movement up is rebalanced at that point. No, it's just repriced to it. So it offered buy side, sell side, and then it goes one more time back up to this level here. Now it's rebalanced. So now at that moment, when the institutional trader that is in alignment with, when I say institutional trader, I'm not talking about Goldman Sachs, not Citi, different kind of breed of person, okay? They're not out there to draw attention to themselves, but they're looking for these types of scenarios to unfold in price, and then they engage. They're looking for price to be down here, like I outlined beforehand this morning on Twitter. That's where the sell side is. Okay, so if the market's up here, and I can see where the market's going to rebalance to, it gives me the opportunity here to see it. I wait for it to come down, and then it goes up. I'm selling short. What? Yeah. See, everybody else out there on Instagram, Facebook, Twitter, YouTube, because I've taught fair value gap, they think everything in the chart is a fair value gap. You have to know narrative. That's why people with my pirated videos are constantly emailing me saying, can you teach me? Because they have not been properly trained. The videos by themselves don't do anything. You got to walk through this stuff real time with me, daily, weekly, monthly, over time. It's not easy, but I have to be the person that navigates it with you, and then you'll learn it. The people that are trying to mimic me, they can't do it, and that's why they cannot have profitable students. The only thing they're seeing, if they have any people reporting they're making money, is because the simplest things I've even taught on this YouTube channel have been parroted. So really, they're not teaching anybody. I'm teaching them indirectly. You're welcome. So the rebalance here, when that happens, I'm going short, and I'm trusting the fact that now, look at this. We'll come back to that in a minute, okay? Because I did a stop loss with this logic in mind. I can trade with ultra small stop losses. But again, the responsible mentor in me, I'm not trying to sell the idea that my students, when they're first learning how to trade, should be going in there trying to trade with 2 pip stop losses on Forex, okay? Or 2.5 point or 3 point handle stop losses in the index futures. I don't think that's practical. I don't think that's practical at all, especially with the level of volatility we've been seeing the last 2 years. That would be unreasonable of a mentor. Now, I'm not a 20-year-old hotshot that's trying to make everybody love me because of image. In fact, I'm probably one of those boring person on the planet to learn from, and that's what you want. You want that because I'm going to take you into the chart and show you the fun stuff, and I don't have to have all the fanfare around it. If you start seeing these things in the price action, I promise you, you will never regret putting the time into these videos because I'm showing you what really goes on that nobody else knows. Because if they knew it, they'd be out here teaching it. They would have shown it to you a long time ago. It's not meant for you. So if you have a setup that's opportunity to see it go down to a level of liquidity, why not short it? That's what I did. I used the logic of this range being repriced, then now it's balanced. I can be a short seller there, and I can put my stop loss above this candle's high, or at that candle's high, knowing that we already had this imbalance, and this fair value gap, I'll just use this candle here. I don't think it's going to go up to that level, because the logic of what I'm explaining here, because I know the algorithm. Think, folks, if these markets weren't rigged, how could I have done that? You knew the levels I was looking at beforehand. And then I executed. And I showed you it was the same account. There is no out for people that want to doubt. You either have to dig into this and put in the work to learn it, or to say, there's something about that guy. I just don't trust him, but I can't do it, so I'm going to move on. Go ahead, do that. There's a lot of good people out there that are doing all kinds of wonderful things to entertain you. I'm not trying to entertain you. I'm trying to teach you. And it's going to be hard sometimes. But this is next level kind of stuff. And it's not in your books. It's not in retail stuff. So being short here, reaching down below, what's this level? That gap. That's why I'm taking a partial. It's hanging around. I'm thinking, okay, it might run up a little bit and bump this order block. I don't want to sit in that. So I took another partial. So half the position off because I went in at 8. Took 4 off on the pass through here, and then 1 more in here in the event that it wants to run out to the order block, because it's non-farm payroll. I could get it wrong. It might get squirrely and run up in here and rebalance to this area here. Not the entire thing, but just bump this. I don't like that. I don't want to be in that much of a retracement. So 4 of the 8, 2 of the remaining 4, and then the limit order, you watch that happen as the recording unfolded. And that final 2 filled out at 38.75 and a quarter. Went down below 38.71.50, which is the old high on the hourly chart that creates the imbalance, of the sell side imbalance. And I know this is going to be hard for you to follow along, but I promise you, if you did what I told you to do in the beginning of the video, it's going to be easy. But you'll have to go back through this video a couple times to really pull out the diamonds I'm laying down here. Then it rallies up, creates that little gap that we'll come back to later on. And then one more time here, fair value gap there. That's that one buy I told you that would be a setup that wouldn't otherwise be drawn attention to. I would use this for pyramiding. So I would have went long here. Maybe even added one here. And then this definitely would have been a pyramiding position. So let's reverse the logic and say, okay, I was using 8 to get in down here. 8 long, 4 more, 2 more. And I would let it run up into here and maybe get into the upper end of the gap on the daily chart where it has no data, that void of trading, where there's no data at all. The purple level, which is not showing here. All right, and here is with the fair value gap and the S&T divergence. Fair value gap trades into that again. Really nice 1 minute chart. Look at the reaction and response around that old gap level. This is the low of that gap where there's no data on the daily chart. Look at the candles. See that? That's real accumulation. Yes, we have little tails on each candle, but this is showing you that the market's doing what? It's accumulating long positions. After a shift in market structure this high here, that right there is the easiest buy signal you will ever have. Buy side aim there. Partial here, 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 and there. Well, what if you don't have that many things to take partials off? Low-hanging fruit, folks. Which is the easiest one to get to? What's your threshold for holding onto a trade? In the beginning, you're not going to be patient. And there's nothing wrong with having your entire position off here and then watching to see if it gets up here. In the beginning, that's normal progression. But it's going to be hard for you to be a buyer down here or here and then hold on for the full position, no partials. That's enduring way too much. That's a stage you go through after you've been doing partials for a while. And then so you want to get to the point where you don't take any partials and you endure the entire trade until it either stops you out, hopefully if you trailed it properly. And I'll give you rules for that. Episode 41. I'll give you the rules about managing your stop. So again, folks, this is not the easy stuff, but this is the business. This is the really real. This is what goes on. This is how the algorithm refers back to price, and it has nothing to do with your harmonic patterns. It has nothing to do with Elliott wave. It has nothing to do with Gann. No Wyckoff. No supply and demand. No buying and selling pressure. The markets are ran by AI, and they're referring back to these levels. Think about it. The evidence is in front of you. It's in the charts every day, every week. All I'm teaching you to do is go in and look for the clues, the signatures. That's what I call them. Signatures. What does that mean? These are things that repeat over and over again, that they're not framed on retail logic. They're framed on algorithmic principles and theory. And if there is an algorithm, you should see evidence like this in the marketplace. And that's why I'm precise when I'm showing you my examples. That's why my analysis is dead on. How many things have you seen me call not come to pass? Think about it. How is that possible? Because it's not because I'm doing things retail. I'm not trading support and resistance. I'm showing you how to find real support and resistance, and it's not even conventional, is it? That's the reason why you get stopped out and you don't even know why the market moved. Because it's doing what I'm teaching. It's running its macro. Short little list of things that the algorithm is designed to do based on time and day of the week and seasonality and the liquidity that's in play. You don't have to subscribe to my view, but it's hard to understand how to learn this without having that mindset. That's why I have to have you endure a lot of things that are going to be very challenging. It's going to be challenging to your perception of price because it's taught that we have a free market. Well, it's free for anybody that has the money to get into it. But it's not a free market where it's not rigged, because it is. And you can get mad, you can get upset and say, oh, this isn't fair. Or you can say, you know what? This is advantageous. Because if it's rigged, it must follow some kind of a method. Well, guess who's talking to you? The engineer.